think of finding stocks in a different way. And one of the ways you can do that is hone in on what area you're looking at. And today I'll look at commercial real estate. So in commercial real estate, you've heard it, right? We all know we're not going to the office as much, right? What does that mean? Think about how that works. If you're going into one of those high-rise buildings in New York or San Francisco or LA or whatever, how do you get into those buildings? You can't just walk in. You have to swipe a key fob, right? It's either a key fob or something on your phone. You've got to prove that you are worthy of being in that building, that you work there. So naturally, that can be tracked. So what I want to share with you here today is some data from that. If we take a look at the actual occupancy rates, I'm going to just get rid of this guy because that's not part of what we're talking about today. We're going to look at the change of weekly occupancy rates as related to those key fobs. And maybe I can pop this up here. I want to try to make it bigger for you so you can see everything. And let's make the chart bigger just so it looks good. Here is the weekly change of those occupancy rates. What we're doing, we're using Castle Systems data. We pulled all the data from them. They are the key fob providers in pretty much any building that you're looking at there. So a lot of people like to look at that. They've got over 3,600 buildings, commercial buildings that they specialize in there that are their clients, and they're in almost every single state. Well, they put together a 10-city average, and then they break it down by every city and everything, so you could check this out. Bad news for commercial REITs, because if you look at the weekly office occupancy rate, we're going back down, right? So we hit a low there during the virus of only having 17% of all active participants or employees swiping their key to go into work. We got all the way up to 24%, which is not great, by the way. And we've been drifting lower ever since, week after week. Now, a lot of people could say, well, that's probably holiday slowdowns, right? And that's very well a possibility, something we'll take into consideration. But if we look at the 10-city national average, we're down to 22.9%, and that's off of last week's high of 24.2%. If we look into those cities, let's go a little bit further here and see who is struggling. So I'm just going to kind of make this bigger. Go like that. Maybe that helps. There you go. Here are the worst cities. So we've got the 10-week average here. It's down 1.3% week over week, so not a big deal there. If you look inside there, you're going to have D.C. is the worst performing areas, less and less people going to work, down 5.7%. Philadelphia, 5%. New York, down 2%. Probably no surprise there. They are the worst performers week over week. So surprisingly, I thought what was kind of interesting, look at the areas that are up. Los Angeles, San Francisco, San Jose, well, you got Dallas in there as well. But you have some of these California areas that are actually increasing going back to work. And to be fair, a lot of those are lawyers. You can actually zoom in that far and take a look. A lot of those happen to be lawyers there. But of all cities, out of all these 10, San Francisco happens to be currently the most shut down. Right? The government basically and local officials have made it where that is the city out of all of them that is technically supposed to be the most shut down, not going to work, but it's higher by 0.3% week over week. People are going to work regardless of what the rules are. So that's kind of a cool way to check it out and see, all right, well, if we know that those occupancy rates are dropping, what stocks do we want to avoid? Do we want to avoid like REITs or anything like that? Well, I'll give you one. I'll give you a couple. So you want to look at Jones & Langs, one of the oldest companies out there. Their income down 42% over the last year. They're mostly in the commercial space. So if you think that this is more than just holiday pullbacks in occupancy rates, you may be a little hesitant to go with these guys here because they're one of the largest in the group there. They are still profitable though. Even though their income is down 42%, they're still profitable. Isn't that amazing? They just started reducing their debt, doing a lot of cost-cutting measures as well. So it's the reason you're seeing the spike there. They're recognizing what's going on and keeping their debt down a little bit lower there. They've also decided they're going to start offering more services in the advisory space instead of being directly related to leases. So that's good news there. But something to consider. If you own that, you're watching it closely. Lastly, we'll look at STOR. STOR is a ticker symbol here. It's a little bit bigger than Jones by market cap, just a touch a little bit bigger there. They've got about 2,600 properties. They've only had 70% of all rents collected. And the reason it started popping here recently is in the last quarter, they said, okay, that number's gone up to 90%, so looking good there. Well, if there's less people going to work and eventually start working remotely, do we see renewal of leases in the long term? So if you're investing in this, this could be a consideration. One last thing about this one, by the way, old Mr. Warren Buffett happens to own this symbol and still owns this position. He has not sold this position. He owns about 10% of all the entire shares of STOR. So something to consider there. That's also the only REIT that he has in his portfolio at the moment. So a lot of people will probably be watching what he does. Not that you would invest in something because one guy does, but it shows that he still has faith and is thinking long term that this is not going to be a big deal. So just kind of a different way of looking at things for our sector breakdown. I thought I'd actually just go through that. The most important part of this story is that it's not always about picking a stock that's hot or investing in something because everybody else is. It's about looking at the data, looking a little bit further. This is normally something I would save for a research post, but I just thought I'd share it with you. Let me know what you think, and we'll go from there.